Mr. Abraham. How are you?
Oh yeah, hello. Good afternoon. I'm good.
I heard you and your friends are struggling to allocate your funds in the market. Is that right?
That's right, that's right.
I have a secret solution to that. Are you interested in any way?
Hmm, interesting. You can say it to my email.
Perfect. I will send you the email and the online meeting. Okay, thank you, Mr. Abraham.
Okay, see you later.
Good afternoon, everyone. Quick check. Can you all hear and see each other clearly before we begin?
All clear on my end. Good afternoon.
Good here too. Good afternoon, everyone.
Same here. Good afternoon. Nice to meet you all.
Okay, perfect. Good afternoon, Mr. Abraham, Mr. Abed, and Mr. Hadifin. Welcome to your group consultation sessions with Nova Wealth Advisory. I'm Wafik, your lead consultant. Today with me are Vito, our market analyst, and Justin, our financial planner. And the three of us will give you a clear picture of where the best investment opportunities are right now, specifically in the context of COVID and what comes after.
Great to meet you all. I know the current situation can feel overwhelming from an investment standpoint. So our goal today is to cut through the noise and give you something practical and clear.
Good afternoon. I'm really looking forward to this session. Group consultation are actually great because you are here each other question and perspective. And a lot of the time one person concentrated on to be actually what someone else was thinking but didn't know how to ask.
That's actually a good point. The three of us have been talking about this for months and we keep going in circles. Hopefully today we can finally get some direction.
Same, we all have money sitting idly, and it feels like every week we wait, we're just falling further behind inflation.
I'll be honest, I don't even fully understand what my options are. I just know a basic saving account isn't cutting it anymore, so I'm starting from pretty much zero here.
And that's completely fine, Mr. Hadefint. That's exactly what session is for. Whether you're starting from zero or already have some experience, we'll make sure everyone lives today with a clear path forward. Shall we get into it?
Yeah, let's go start.
Okay. Before we give any recommendations, we need to understand where each of you is starting from. Good advice has to be specific to your situations, not generic. So let me ask each of you the same three questions. How much are you looking to invest? What's your goal? And how do you feel about risk? Abraham, let me start with you.
Sir, Mr. Wafi, I have around 500 million rupiah in saving sitting in a bank, doing almost nothing. My goal is steady growth over the next 3 years or 5 years. I'm not chasing a big returns, but I just don't want inflation to eat away at it quietly. And on the risks, I honestly feel cautious. I would rather grow slowly and sleep well at night than chase a big returns and panic every time the market moves.
Very clear. Conservative profile. Medium time horizon. Capital preservation is the priority. Good. Abed?
Well, it's a different story for me. I have around 200 million rupias, and I'm okay with taking real risk. I'm younger and I have no major financial obligations right now. And I just want to grow this aggressively. I can handle volatility, but what I can't handle is seeing my money just sit there doing nothing.
Aggressive growth profile. Understood. And Mr. Hadifin,
Sorry,
what's your
we can hear
situation?
you. Can you repeat
Uh,
that?
okay, I'm sorry. Classic aggressive growth profile. Understood. And Mr. Hadifin, what is your situation?
I'm somewhere in the middle of those two. I have about 300 million. I want decent returns, not just beating inflation, but actually building something meaningful. But I also can't afford to lose most of it since this is money I have saved over several years. So I want growth, but with some guardrails.
Okay, so a balanced profile growth oriented but with downside protection in the mind. That actually a very common, a very wearable profile. And one more question. For all three of you, have you invest before or it is your first time?
Actually, I tried mutual funds a few years ago, but pulled out when COVID hit. So everything felt too uncertain.
I bought a few stocks here and there, but honestly, I was mostly guessing.
Nothing completely new to this. The most I've done is put money in a time deposit at the bank.
Perfect. That gives us a very complete picture of three of you, three different profile which actually work really well for a group session like this because this recommendation will show you the full spectrum of what possible depending on your risk appetite.
All right, let's get into what we actually recommend for the current moment.
Okay. We have identified three investment terms that make the most sense right now given the in the pandemic context. The first is technology and digital economy, and the second is healthcare and biotech, and the third one is recovery plays from the sector that have been hit hard by COVID but are set to bounce back and apply strongly. Each each term has a different risk level, and we will explain how each on the differently fits from for Abraham, Abed, and Harifin.
I like that you're framing it around themes. It is easier to understand than just a list of fun names.
Which is exactly why we do it that way. Let's start with the technology term. COVID essentially forced the entire world to go digital and almost overnight. Remote work, online shopping, digital payments, video calls, and what would have taken 10 years happened in one. The, com- the companies powering all of that, like cloud platform, e-commerce, and fintech, have, have seen explosive growth. And here's a key point. This isn't a temporary spike, but people who had never shopped online before, now they do it every week. That behavioral shifting is a permanent. For Abraham, who prefers the lower risk, we recommend diversify the tech mutual fund, and you get exposure to the sector without betting on any single company. For Mr. Abed, individual stock from the Southeast Asian tech space, earlier stage companies with more upside potential but more volatility, and for Hardefin, a mix of both, some fund exposure for stability and small allocation to regional individual stock and for added growth.
So mutual funds make sense for me, but I don't have the time or confidence to pick the individual stocks. So having professional manage it feels right.
Southeast Asian tech specifically. I actually like that angle more than just buying US big tech because the growth story feels a lot more real and definitely a lot more closer to home.
The hybrid approach sounds good for me. I get some of the upside without going all in individual stocks. I don't know well yet.
Now the second, healthcare and biotech. This one most of it explains itself. The pandemic has put healthcare at the center of global attention and global spending in a way we never seen before. government, institution, and private investor are all pouring money into this sector. But here, what most people miss, it not just about vaccine companies making the news. The bigger opportunity is in the ecosystem around healthcare, the unity, medical supply chains, health data platform, telemedicine. Those company benefit regardless of which specific treatment or vaccine wins. They are more stable and have a longer term growth driver. For Abraham, a healthcare focused mutual fund for Abed, selective biotechs and health tech stock with high growth potential for Hadapin again a balance split fund for the core few individual name for added upside.
So I was going to ask about the just buying vaccine company stocks, but that does sound more like speculating than investing.
Yes, it's very right, and that is thing. To look past the headline is our spread a smart investor from someone chasing news. The company that quietly build the infrastructure of healthcare tend to win a long term.
What kind of returns are we talking about in healthcare?
For the historically quality healthcare platform have a return 10 until to 15% annually over a 5-year horizon individual health. That stock can return significantly more, but also carry more downside. It depends on how selective you are.
Mm. And the third theme, this is the most interesting one, and also the riskiest, recovery plays. These are sectors that COVID has completely crushed. Travel, hospitality, retail, commercial property. Right now, they look terrible. And that's precisely why they're worth paying attention to. The logic is simple. The demand hasn't disappeared, it's been suppressed. People haven't stopped wanting to travel or eat at restaurants or use office space. The moment restriction lifts and confidence returns, that pent up demand release. And it releases fast. Buying into these sectors now while they're still beaten down means you positions before the crowd catch on.
That makes interesting sense, but isn't that exactly what feels scary buying something that looks bad right now?
Yes, of course, and that discomfort is actually the point. If recovery stocks felt safe and obvious right now, everyone would have already bought them and the price will already reflects the upside. The opportunity exists precisely because it's uncomfortable. For Hardefin, we suggest a small measured allocation here, enough to benefit from the recovery without overexposing yourself. For a bit, larger allocations make sense given your risk tolerance. For Abraham, we keep this very light. Maybe just a small positions in a diversified recovery fund rather than individual names.
So a small position I can live with, but I just don't want recovery to take 5 years and leave me stuck.
Understood. We never suggest putting a large chunk on a conservative portfolio into a recovery stock. A small technical position is enough to participate without taking a excessive risk.
Okay,
Excessive risk.
I want to ask about timing. I'm nervous about investing right now while COVID is still ongoing. What if market drop again significantly before things get better? So I don't want to put in 500 million rupiah and watch it drop 20% in the first few months.
That's the most common concern we hear. Abraham, and it's a completely legitimate one. Here's the honest answer. Yes, markets could drop further before they recover. Nobody knows the exact bottom, but trying to wait for the perfect moment is a strategy that almost never works in practice. What we recommend instead is spreading your entry over 3 to 6 months. Put in a portion each month rather than everything at once. That way, if the market does drop after you first purchase, you are buying more at a lower price, and your overall average cost because becomes more favorable. It removes the pressure of having to pick the perfect moments.
Okay, I understand. So I'm not betting everything on today's price. That actually makes me feel a lot better about starting.
Exactly, it's a cost averaging and is a one or more the most effective tool for the managing the emotional side of investing, especially during a uncertain period like this.
My concern is different. For the recovery plays, how long would it take realistically before those sectors actually recover? Because if it takes 4 years, that's 4 years for a big chunk of my own money is underperforming.
That's a fair and smart question. Our current view is that we'll see a meaningful recovery beginning in the 2022 and accelerating through to 2023 as vaccination vaccination rate and rate rise and globally and travel restriction rise. But we will then suggest that putting all your aggressive allocation into a recovery stock for exactly the reason you mentioned. But we split your higher risk position roughly to prepare for medium term momentum and 30% into a recovery play for the downside side. And that's why you always have something in your regardless of which timeline place but or first.
Speaking of which, what about the gold? I keep hearing that gold is the safe bet during a crisis. So I'll be putting money into gold.
Gold is worth having, but in the right proportions. Yes, it's a safe haven assets. It holds value when everything else drops, which make it useful as a hedge. But gold doesn't generate returns the way productive assets do. It protects value. It doesn't grow it significantly, which suggests keeping gold to around 10 to maybe 15% of your portfolio, enough to act as a buffer during volatility, but not so much that it drags down your overall growth. Think of it as insurance rather than investments. It has a job to do, but it's not the main driver of your wealth.
So, looking gold as an insurance, I really like that framing. It makes it much easier to think about how much to allocate.
What if I want to start very small just to get comfortable? Is that okay? Like not putting in the fully 300 million right away?
Absolutely. And we actually encourage that for someone who have completely new to investing, start with 20 to 30% of what you're planning to invest and get familiar with how the platform works and what's how the your portfolio move and build your confidence. And then add more over the following months. Investing is a skill you develop over time. Starting to small and learning is a far better than waiting until you feel 100% ready, because that moment rarely comes.
That's exactly what I needed to hear. I will start small and building from there.
All right, let me summarize what we've discussed and lay out a clear recommendation for each of you. Let me think. Abraham, conservative profile, 500 million rupiah, 3 to 5 year horizons. We suggest 40% in a diversified tech mutual fund, 25% in a healthcare fund, and 20% in a small recovery place fund, and 15% in gold. I'll enter gradually over 3 to 6 months, steady, balance, and low stress.
Yes, that's very management, Mr. Wafi. Nothing too aggressive, and the gradual entry takes away the timing anxiety completely.
Okay, thank you. And for Abed, aggressive profile, 200 million shorter patience horizons, we suggest 40% in Southeast Asian tech individual stocks, and 30% in healthcare and biotech stocks, and 20% in recovery plays. And lastly, the 10% in gold as a small buffer. Higher upside, but you need to be comfortable with short term swings.
Hmm. That's 40, 30, 20, and a 10 split. I mean, it is clean, and at least I do know what I'm doing with each portion and why. Well, it definitely does make me at least confident in sticking to it.
Okay. And lastly, Hardefin's balance profile, 300 millions grow with guardrails, which suggests 30% in a tech mutual funds, 25% in healthcare funds, and 20% in small selections of regional stocks. For added upside, 50% in a recovery place fund and 10% in gold. Start with just 2 to 3% of the total first to build familiarity. Then add the rest over the 3 to 4 months.
That fresh approach is perfect for me. I get to learn as I go without overcommitting before I understand what I'm doing.
Okay, one reminder for all three of you, please don't check your portfolio every day. Set a reminder to review it every 6 months. Short-term fluctuation and the normal and expected the biggest mistake most new investor make is a reacting emotionally to day movement. Your strategy is built for the medium and long-term trust it.
Guilty as charged on that daily checking. I try to be more disciplined about that.
Same, I already feel the urge to check it constantly. I will set a calendar reminder for the 6 month review instead.
It's a good advice. I think the writing pen will help me stay committed too. It's harder to panic sell when you have a document reminding you have the logic behind each decision.
Here's what happens next. Justin will prepare a personalized investments plan document for each of you within 2 business days. Clear, specific with the exact allocations, recommended funds, and a timeline for entering the markets. Once you review it, we'll schedule individual follow-up calls to answer any final questions and help you to take the first step. Does that work for everyone?
Works perfectly for me. Thank you, Mr. Wafi.
Same. I'm looking forward to the document at least.
Okay.
Having it writing make the whole thing feel much more real and achievable.
We have everything ready and in your inbox by end of this week. And remember, our team is available anytime between now and then. If equation come out, don't hesitate to reach out.
Thank you so much, Mr. Justin, Mr. Wafi, and Mr. Pito. This has been the most useful financial conversation I have had in a long time.
Agreed. It's real advice and real talk, and there's no fluff around it. I appreciate that.
I came in a feeling completely lost and I'm living with an actual plan. That's more than I expected from one season. Thank you all.
That genuinely means a lot to us. That's exactly the outcome we aim for every time. On behalf of Vito, Justin, and myself, thank you for trusting us with your financial journey. We'll be in touch very soon. Take care, everyone.